This year, 97% of agencies raised their prices or plan to, and a huge number of them are still going broke a little bit every single month. 97% raised prices, but most are still leaking because most agencies aren't losing money on what they charge. They're losing it in the plumbing, work they never billed, invoices sitting for 2 months, revenue that swings so hard nobody can plan around it. Here's the part nobody tells you. Plugging that leak is only half the job. Let me show you the other half because it's where the real money is. So there's a report I want to point you to because the numbers in it are brutal and you should see them. It's Ignition's 2025 Agency Pricing and Cash Flow Report. More than 270 agency owners were surveyed. And my friend Drew McClellan over at the Agency Management Institute broke it down in a piece that's worth your time. There's a link to that in the description. Full credit here to Drew for that diagnosis. We work with a lot of AMI members, so I've had this exact conversation more times than I can count. Drew tells you where the money's leaking. I'm a CPA, so I'm going to tell you what happens to that money after you stop the leak. And that second part is the half almost nobody talks about. Here's how I want you to hold this whole video in your head. Plug the leak, then keep what you plug. 2 moves. Most owners only ever do the first one and then wonder why they still feel broke. Let me walk through the leaks the way they actually hit your bank account. Cash first. Leak number 1 is late payments. And I'm starting here because this is the one that can actually take you down. The report says that 97% of agencies deal with late payments. 71% say at least 1 in 4 invoices is overdue. And more than half say clients pay 2 to 8 weeks past due, and only 16% ask for any money up front. Crazy. Drew had said it perfectly. Waiting 30 to 60 days to get paid is handing your client an interest-free loan. I'll go one step further. It's an interest-free loan you're funding with the money you needed for this Friday's payroll. And this is where I have to say the thing I say to every agency owner who will sit still long enough to hear it. Profit and cash are not the same. A beautiful P&L can still bankrupt you because the P&L says you earned it. The bank account says it hasn't landed yet. You can be profitable on paper and still sweat the 15th and the 30th. That gap between earned and collected, that's where the late invoices live, and that's the leak. So how do you plug it? There's 3 moves. 1, collect before you kick off. A deposit does 2 jobs. It screens out the client who is never going to pay well, and it puts real cash in your account before you spend the dime delivering. 2, let the system do the chasing. Automatic reminders, auto debit, so getting paid stops depending on whether somebody on your team remembered to send the awkward email. 3, mean it when you talk about late fees. If they're in the contract, enforce them. A rule you won't enforce isn't a rule, it's a wish. Leak 2, scope creep is free work. Leak number 2, scope creep. And this one hurts in a way most owners never actually calculate. Nearly 80% of agencies say they rarely or only sometimes charge for work outside the original scope. More than half figure they're losing between $1,000 and $5,000 a month. Once again, 80% don't charge for out-of-scope work, 30% lose $5,000 a month. Let's take the low end. That's $12,000 a year of work you did and gave away. And it always starts small. And the revisions always start small. A couple extra revisions, an unplanned strategy call, a bonus round of creative because the client's launch slipped. Nobody invoices any of it. And pretty soon your team has learned that the boundary was really just a suggestion. Now here's the part that makes it worse than it looks. And this is the CPA in me talking. That $12,000 isn't top line revenue you missed. It's gross profit, it's net profit. The money you actually keep after you've paid to deliver, walking straight out the door. Remember, unbilled scope comes right out of gross profit and net profit. Think about it. Your people already got paid to do that work. The salary went out, so the entire loss lands on your bottom line. There's no cost left to net it against. $1 of unbilled scope stings more than $1 of lost billings. It's pure profit gone. So 3 moves again. Put that fence in the proposal, write down what's included and what's extra so it's on paper, not remembered 2 different ways 3 weeks later. Read the boundaries out loud together on a live call. Get the client to agree to the edges of the work before the work starts, not after the friction begins. And make change orders the normal thing. More work means more agreement every time. So your team stops quietly absorbing it as a favor. Agree out loud. Normalize those change orders. Leak number 3, How you price is why the revenue won't sit still. Leak number 3 is the biggest because it's not about one project, it's about the shape of your revenue. Nearly 30% of agencies still default to billing by the hour. I get why, it's familiar, it's easy to explain, but think about what it actually does. Hourly change your income to how long someone takes, instead of what it's worth. So the better you get, the faster you get, the less you earn. And that's a strange way to run a business. And it feeds the number in this report that should generally stop you cold. Only 8% of agencies say monthly revenue is highly predictable. Only 8% call their revenue predictable. 92% are guessing. Let's read that again. 92% of agencies are guessing. And that volatility is why hiring feels risky, why investing feels reckless, why one slow month turns into a quiet panic. But here's the good news. Those two problems, the pricing problem and the predictability problem, have one fix. When you move your repeatable work off the clock and onto package subscriptions or retainer pricing, you solve both at the same time. So you stop requoting the same engagement from scratch every single time. Build the bridge past the finish line. Every project should end with an obvious next step. A monthly support plan, a content plan, an optimization retainer, not a cliff. And convert a few, not all of them, but a few. You don't need every client on a retainer. Even a handful of recurring contracts changes how the entire year feels. So here's the half that nobody teaches. Keep what you recover. Okay, say you do all of it. You tighten collections, you kill the scope creep, you move to packaged pricing, and you build some recurring revenue. You've now recovered real margin, and I mean that. That's hard, but it's good work. But here's the question almost no agency owner asks, and it's the whole reason I made this video. Who keeps the margin you just recovered? Who keeps that recovered margin? Because right now, with no plan, the answer is often the IRS keeps a third. So let's think about that. You did the hard operational work to stop the leak, and then a big chunk of what you recovered goes straight back out the door to Uncle Sam. That's no longer a plumbing leak. That's leaving money on the table on purpose. And this is the difference between a tax preparer and a tax advisor. A preparer records what already happened and files the form. That's the rearview mirror. They'll tell you what you owe after it's too late to change it. Proactive planning looks through the windshield. Before the year closes, you decide how the entity is structured, when income lands, which strategies you are legally entitled to use, so more of that recovered margin actually stays yours. Filing a tax return isn't a strategy. It's just documentation of what a strategy would have saved you. So here's the full picture. 3 moves, 1 goal. Plug the leaks. That's the operations work Drew lays out, and it's right. Watch the cash, because profit isn't cash, and knowing your numbers is what keeps a profitable agency solvent. And plan the tax, so the margin you fought to recover doesn't get quietly clawed back every April. That's the whole game. Keep more of what you make. So here's what I want you to do this week. Just one thing. Pull up your accounts receivable and answer one question. How much of the money you've already earned is sitting in someone else's bank account right now? If you don't know the number, that's a tell. That's a leak you're not managing. And if you want a second set of eyes on where your margin is actually leaking, and more importantly, how much of what you recover you'd actually get to keep, that's exactly what we do. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got 2 things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.